Well, almost officially in 1 minute, good afternoon to the East Coast and morning to the rest here. We're going to get another minute for other participants to join, and we will get started.
While we're waiting, can we just see if folks can see the screen?
Yeah, and
You
and
get
hear
a
us. So that was the
raise hand if you can hear and see.
right.
Uh-oh, no one's raising their hand.
There you
Okay,
go.
there we
There's
go.
Babs.
Thank you,
All right,
Babs.
panic, panic. I'm sure everybody could see our nonverbal communication there, where our eyes got twice as big as they were. The joy. Okay, well, I've got noon. We're going to go ahead and get started here too. So I'm Brian Klontz, president of Charitable Solutions. Have my two colleagues here, Ryan Raffin and Laura Malone, will be taking us through the forensic deconstructed post-mortem. This is backed by, we're going to say popular demand. It probably wasn't, but this worked out real well last year. So this is an update, obviously, with the same format that we had done last year for 2024 trends and or activity with 2025 trends. I don't think any of us can remember what we expected the 2025 trends to be, but we could make it up and act like we were spot on. But we'll be doing the same thing today. So obviously revisiting 2025 activity and what we somewhat expect and what we're sort of seeing already here almost 1/4 of the way through the year with some trends there too. So I will go through also quick housekeeping notes. As many of you know, we do not provide the slides directly, but do indirectly. We do now have, I think this is our 66th or something, webinar, all free on our YouTube channel. And that's all available, obviously, for any of our past ones as well. So that will be coming out next week. Also, very importantly, we hope this is actually going to be a very interactive session. And any Q&A that you have, you can just include that down below, and we'll be able to answer either within that sort of chat function or in real time. So the mission of our firm since day one has been to help make charitable gifts happen that otherwise wouldn't. We'll be talking about that exclusively today too. And so I'll go maybe top right over. So Emergency Assistance Fund Administration. So we have a separate charity called the Emergency Assistance Foundation that makes grants for disaster relief and personal hardships to individuals, and we do that globally. Education and training, this is a big one I want to point out, still highlighted, thankfully. So a big priority for this year is around our plan giving AI tools. So we have our Gift Planners workstation and then our co-pilot sort of AI agents that are Frank for professional advisors and Max. We've done a number of webinars on this. We have had, I think this is true. I think it's about roughly 85 to 90% of the people going through the demo are signing up. So if you don't want to sign up, don't do the demo. Maybe that's another way to think about it. But people have been very happy, and we sort of, as a firm, use these tools all the time. So to be very clear, it's a contained library, intentionally curated only in the charitable planning space, of which much of which is including the non-cash assets, more specifically in transactions. So we have, and then other professional advisor CE webinar, virtual and in person that we do too. Charitable appraisals. I am being inundated right now with 2025 appraisals for cryptocurrency. It's probably 2 to 3 a day. I think that's probably about right. And then also doing a lot for life insurance. Everyone trying to jam these in, of course, before the April 15th deadline. But we also do a lot around business interests, and you can see anything else that can be donated to charity. We sort of cover there too. Doing a lot of activity in the gift annuity space. A number of very interesting ones. Kind of forget. Frankly, we've got 2 or 3 really interesting ones that we're working on right now. Might be good fodder for future webinars. But that's really through our National Gift Annuity Foundation, there bottom left. We're actually approaching about 1,300 contracts now. All of these have been referred by other charities that do not want to continue issuing, that don't want to start issuing, that don't want to issue CGAs in a particular state or for a particular asset. So bottom line is, for whatever reason, if you have a donor or client that wishes to have a gift annuity, and for whatever reason it's just clunky or not a fit, a number of these, for example, come up where the person says, I love charity A, but I also love charity B, C, and D. And so charity A is like, we love you too, but we don't want to do gift annuities. That's not part of our exempt status, not part of our risk sort of guidelines to be issuing, in essence, gift annuities for other charities too. So a fairly elegant solution is just to refer it over to National Gift Annuity Foundation, and we're doing that, of course, for all 5 charities. So it is very simple. And then at the back end, most importantly, 100% of the residuum is granted out. So nothing stays with us. That's just going back out to the charity and charities that the donor was trying to give to in the first place. Around gift annuity risk too, got 3 of these right now I'm working on. So we have an actuary on the team that we do actuarial stress test of gift annuity pools, generally larger ones, or if it's a very, very large gift annuity going into a pool, specifically just had a call Monday, I guess, yesterday, on a case that was to a Southeastern university. They have 1 million total, million and a half in their gift annuity pool, and this donor wanted to do a $6 million gift annuity. So it doesn't take an actuary to figure out that could be a problem. So we're sort of talking through various solutions on that particular case with that charity again to help make that gift happen, and that's the key. And then what we're going to be talking about, obviously, we being Ryan and Laura predominantly today, is around our non-cash asset. So I won't go into that too much. We're going to go through, obviously, a bit of that today, just to sort of tease out. I think we're now over 7 billion in donations that have actually been completed. Again, most importantly, 100% of those were initially declined by the charities who referred those gifts over. My guess, we should have a better count on this, but my guess is we got maybe about 3,000 or so referrals, some of them very light, some of them very bad, I'll just say. But referrals just the same. There are emails or phone calls from the donor or phone calls from charities or from advisors to complete roughly 650 of these donations. So my point here is a whole lot don't work out, and that's fine. But it always weirdly tends to be about 8 referrals for every 1 that completes. And so last year we were getting roughly about 15 or so referrals a day. That's average. So end of year, obviously, that's sort of through the roof. But if you sort of average it out across the year, which then creates roughly 2 completed donations per day. So with that, I guess you want to maybe jump forward to the sort of activity piece 2 there, Laura. So I can go through this briefly. This is the deconstructed forensic post-mortem that Ryan and Laura will be going through, in particular, sort of plucking out some more of the interesting ones. But you can see there it's about 645 donations. This does not include CRT activity or CGA activity. So we do a fair amount of these that are short-term CRTs with non-cash gifts. But then I think we did maybe 15, 18-ish real estate for gift annuities last year, crypto for gift annuity, so other types of assets too. None of those would be included sort of in this count. Interestingly, you can see that our ratios remain very, very tight in terms of sort of historical ranges. So real estate, you can see there, that very much understates real estate because a lot of real estate is held by an LLC as sort of the single asset, as an example. And then also, for example, S Corps, you can see the business interest there too. That's probably at least double, would be my guess, at least, because a number of LLCs elect to be taxed as S Corps. So those obviously are really S Corps in terms of how they functionally operate, UBIT ramifications, and so on. But legally, they are LLCs, so they'd sort of be falling in that bucket. The point in all of that is 5 years ago, 10 years ago, 15 years ago, if you look at the real estate to business interest ratio, it is, again, very strangely consistent over time. Clearly, in this case, it has just gone way up. So these are records for us in our 23-year of existence times 2. So this sort of doubled all activity that we had as prior records, both in terms of number. For example, in 2024, I think we were around that 280 total donations, so the 280 to 645. And then we were around the 750 million or so total value. Obviously, it was over 1.7 billion last year. So again, the ratio stays the same, but everything just sort of doubled. Crypto is the thing that is very volatile, which is sort of, duh. But we've had a number of years where the total crypto activity has typically been around 1.5% of everything that we did, even though the number of inquiries we get, that might be like 30 times that amount. So lots of inquiry, maybe, I don't know, at one point it was maybe 10 or 15% at least, maybe 20% of all of our inquiries from charities in particular were around crypto, shiny thing, we want to chase that. But it ended up being about 1% of all of our transactions. Clearly, in this case, it's around, roughly 8, 10% of the amount, and roughly whatever that is, 20% of the actual donations, given the obviously huge run up in crypto values last year. So goes crypto prices, so goes activity, which again is somewhat obvious. But the more stable component of that, even in sort of 2008, 2009 recession period, and obviously COVID period, that real estate to business interest ratio is just very interesting to me, how stable that tends to be. And then we had a bunch of other weird stuff. So you can see there that we'll talk about that too. So with that, I'll maybe pass it over to Ryan. By the way, Ryan is our managing partner for all non-cash assets. So leads our whole team, including Laura and others. So Ryan, I'll pass it over to you.
Yeah, thanks, Brian. And I think that last slide there did a good job teeing up kind of what Laura and I are going to focus on today. The agenda here is going to be quicker than it is maybe other months, other webinars. We're going to talk about what we saw in 2025. We're going to talk about quickly the new tax law implemented last year, now in effect as of January 1st. And then pivot to sort of what we've seen so far in 2026 and what we think kind of our expectations are, and what we think might be some opportunities for charitable giving in the more complex charitable planning space that we're in. So with that said, I will just talk now about, and this will be pretty conversational, I think, between Laura and I. We work together on a lot of these. Some of these, one of us handled, but not the other. So you'll see, a lot from each of us. So the first one that I wanted to talk about, the family business pre-ESOP, ESOP standing for Employee Stock Ownership Plan. That was an extremely complicated gift with extreme urgency. I think it was referred to us on Christmas Eve at noon Mountain Time. I know this because I checked right before the webinar. So very last minute. And not only was it a family business, it was a group of family donors. So multiple donors. And it was an S Corp. So we're just ramping up the urgency and the complexity with, number of donors and transaction and at the absolute last minute. And this was an interesting donation for a lot of reasons. We see these ESOP donations usually a couple times a year, and they can work very, very well. With an employee stock ownership plan, there's kind of an alignment with charitable intent. They don't necessarily mesh together, but there's sort of a philosophical alignment where if you are a business owner who is inclined to sell your company to your employees, oftentimes you're also the kind of person who is inclined to do some meaningful charitable giving. So that can work really well in terms of sort of donor motivation. What also can work well is because these transactions are so complicated and require such specialized advisors, layering in some complicated charitable and tax planning is maybe it's upping the complexity, but not in a meaningful way, kind of in for a penny, in for a pound type thinking. So these donations can work pretty well. Obviously, this one was a little bit unique in that it was so last minute, and we had a large group of donors. I think it was a dozen plus coming in, at the very end of the year, and it wouldn't have worked without the family's attorney team really helping to sort of wrangle signatures and getting all of the paperwork completed from each of these donors. So that was, I don't know if I would say fun, but it was an interesting and very meaningful, really, gift at year end. that had significant charitable intent because we're talking about 12 people who kind of all put their heads together and agreed they were going to do some charitable giving as part of this pivot to an employee-owned business.
It's always
The
great
next
to see
one,
those unfold.
yeah,
Yeah.
yeah,
Year end is always interesting for those events, especially when you're dealing with family and multiple signatures. It's interesting though, and we'll pivot for a second because, I think about all the years that Charitable Solutions has been doing this. We're approaching not too far away from 25 years, and I think folks would think that there's not many things that could stump us. And I don't know if the municipal real estate developer free credit stumped us as much as just we'd never seen one of those before. We'd never participated in one of those before. And that was an interesting thing, for the latter part of the year for Ryan and I, in the sense of, okay, what is this? How does this work? And, it is to some degree kind of how it sounds. The city has fee credits that they issued, that developers would purchase to help pay for the infrastructure of their large scale projects, the roads, all the different things needed throughout the city. This donor had some left over that they were unable to use or did not need as much as they thought they would need with their development projects that they were working on. So they wanted to donate those. And it took an added day or two to kind of get our hands around what is this? How does it work? How does it transfer? How does it get valued? How can we get out of this at some point in time? But once we were able to kind of sit down and kind of talk more with the donor, talk more with the municipality, get our arms wrapped around this, that what was truly really more simplistic than I think we were initially giving credit to, it worked out to be a very nice donation of, $2 to $3 million for that transaction. So I think that was, definitely one of those things as we think about the landscape ever changing and ever evolving. I think this is an example of that in the sense of, I'm not really sure how many municipalities do these types of credits and whether this is, something that we'll see more of in the future or if this is just tied into that particular region where this existed, but it definitely was, a new one for us to have some fun with towards the end of the year. Another thing that we see, maybe less common, but as part of our real estate, the idea of the mixed use real estate. This was in a larger municipality, big city area where you had roughly about an $8 to $10 million property that was a little bit of everything. It was a bar, it was residential apartments. It had, ownership it was one of those that Brian referenced that was an LLC holding the real estate. So that LLC actually had a liquor license that it had control of as part of the bar and part of the lease of the bar. So a lot of different moving pieces that made that really interesting, trying to get that through, to the end of the year and get that completed with the different nuances that went on with each of those different facets of that structure that took place. Another thing that we saw was the idea of this acceleration of the charitable remainder unit trust. And I think oftentimes we talk about the creation of charitable remainder unit trusts, but we don't always talk about how somebody can get out of a charitable remainder trust. And this was an interesting development where the CRT was created a number of years previously. The donor actually was finding that she was coming into another liquidity event that really made this income unnecessary for her. So she felt comfortable with the idea of being able to, donate the balance of the CRT. She hadn't really taken any income out of it as of yet. So to be able to transfer all of that over to us, and, we're currently working through really kind of dissolving everything that's in the CRT as part of that process for the final value of her donation and her liquidity that would happen. That'll transfer into her donor advised fund at the end of the term of once everything is dissolved. So that was an interesting thing that we see sometimes where, and I was reminded by a mentor of mine of another similar scenario that we had at another organization where these can really create an acceleration of meaningful gifts for donors, where, they can create something with near-term liquidity rather than waiting for that term of life of the CRT, so to speak, to take place. Another one that finalized at the end of the year, and I don't know if we felt comfortable with talking about it in our weird and wacky that Ryan and I did in November, was the idea of a donor that was giving a name, image, and likeness structure. For those of you that are, big into the college scene, you may have heard the idea of the name, image, and likeness structures for student athletes so that they can get compensated for, their activity in college sports. A lot of these NIL collectives are independent groups of pooled funds that create the opportunities for the students to be able to get compensation. Oftentimes they may be tied in or hope to tie in with various universities that are in that high level sports space. So that was an interesting one that it took a little while to get everything finalized, but that was something that, finally came to be and finally came to fruition, towards the end of the year, and I think was also another first for us in that space. So, again, kind of like with the fee credits, as some of these things evolve, as some of these things come into fruition out in the marketplace, those can be great opportunities to create a charitable spin on them as well.
Yeah, and a lot of these are, we highlighted these because they're unusual even for us. The fee credit thing was a total learning experience for both Laura and I. I mean, the mixed use real estate, we see that sometimes, but I think for me, it was really illuminating learning how pivotal the liquor license was as part of all of that. Not to give away too many details, but that property is in the Northeast, where the liquor license laws can be a little archaic, I think, compared to the rest of the country. Um, this stuff can really it can go in directions that we don't expect when we first get on the call. The name, image, and likeness stuff that's changed. That landscape changes so rapidly from state to state and probably federally soon as well that you really have to be willing to um, pivot again as needed. The corporate sponsored stock donation, that was something that we did talk about on the November webinar, but then we had a separate company, a separate startup come to us at the end of the year, and they wanted to do it as well. And the one that I mentioned on the webinar was very organized, thankfully. It was a large number of donors, but the company was very focused on uh, getting a streamlined process and having clear communication, and they were great to work with. This one was a little more loose. It was kind of the founder, the senior executives just exchanging emails and saying, well, we think some of the other big investors might be interested, and we can do this kind of at the company level. Um, but it kept lagging later and later into the year. I think it was first being discussed in November, but then it kept slipping later and later into the year. And there was only so much we could do to kind of prod these donors and say, look, we're running out of time here. We really need you to make a decision so we can get started on the paperwork and get this done before year end. If you're talking to kind of a corporate donation group, I think for me, that really showed how important it is to have um, a really dedicated effort by the corporation to have people who are maybe on their legal team or their investor relations, stock management team, uh, who are have this as one of their tasks and they're devoted to it so it gets done. Because if it's just sort of loose, it can be difficult to manage without a few people on the company side who are doing that herding of the cats. Anytime you get a big group of donors, it can be a challenge, like I mentioned with the ESOP. And just wrapping up kind of the notable donations here, just to emphasize, and Laura mentioned this or alluded to it, these are all donations that came in the last 3 or 4 weeks of the year, sometimes in the last 3 or 4 days. Uh, None of these were included in our November webinar. So we did have a whole separate group of earlier 2025 donations that we talked about in November. Supercar, farmland, the book of business. That's a really weird one that Laura worked on. a large commercial real estate. So if you want to hear more details about those donations, we have the whole hour from the November webinar on that. But if as we think about kind of the whole year holistically, not just the last 3 or 4 weeks, but the whole of 2025, what did we really see a lot of throughout the year? Um, Overall, this first bullet point on the slide was a last minute addition by me. Um, DAF giving overall across the country seem to be significantly up. And this is kind of a continuation and acceleration of a trend that's been going on for probably about 10 years now. As Brian mentioned, we saw a significant increase in activity in 2025, but I think you'll see that's true across all of the big national DAFs, big community foundations. Once they publish their 2025 numbers, you're going to see significant increases. That's what we've heard in our kind of early year conversations with a lot of our partners. They said, we don't have the 2025 numbers fully baked yet, but yeah, big year. And we've heard that time and time again from different partners. So I think you're going to see a lot of donor advised funds saying it was our best year ever, because for a lot of them it was. Specific to us, and probably a lot of other groups as well, the AI space saw a lot of charitable giving. It was in the news all through the year in terms of various impacts of these AI companies. And because there was a lot of money moving to invest in these companies, there was a big incentive, because so many of these employees had received stock as compensation. They had taken some money off the table. There's an incentive for them to give. We saw a lot of AI-related donations. A lot of that was in the form of startup stock, but some of these were more directed investments where we had donors, usually with some kind of financial background, say, I'd like to have my DAF invested in this AI startup. Can Decami do that for me? And that is something that we can do in the right circumstance. And then in other cases, we actually had things that weren't AI companies directly, but were in a related industry, particularly data centers. So we saw some donations in kind of related industries. So AI was very big in 2025. It looks like that's going to continue. I mean, just today I saw that there was IBM had a major AI company acquisition. So we expect that to kind of continue, and we'll talk about that more. Crypto of all shapes and sizes. Brian mentioned this. The crypto donations, Bitcoin, Ethereum, Solana, you name it, we must have done, I don't know, probably 15 different cryptocurrencies, if not more. Alex Cedar, who many of you might know from her work with our gift annuity program, did a lot of work on the crypto gifts throughout the year, as small sometimes as about $20,000 on the high end, well into 8 figures. So really ran the gamut, both in terms of the particular type of cryptocurrency, but also the value. So really interesting year for crypto. Saw this was at the tail end of the year, a lot of REIT inquiries, and we've never really done a lot of REITs, and that's a real estate investment trust. And so, at least for me, we've never done a lot of them. I don't know or didn't know a lot about them. And in the last 3 or 4 weeks of the year, I learned quite a bit, because we got so many of these. And I learned, when we're talking about REITs, they can be private, they can be public, they can be convertible from private into publicly traded REITs. It can be something where the owners get a 1099. And so for a charity, that's good, because that means you're probably not going to see any UBTI. But they also have a variant that is taxed as a partnership. So you do instead get a K1. And then because these are real estate investment vehicles, there's usually a lot of leverage. So then we do think there's probably likely to be UBTI. These REITs come in a lot of different flavors. They can be pretty complex, and they don't always work out for donors because of bargain sale issues. But in the right circumstance, and we saw a few of these at the end of the year, they can work pretty nicely. And so we did see some of those gifts go through. And the good thing is with these REITs, there's a pretty clear path to liquidity. So despite all of the other kind of noise regarding tax treatment and whether there's going to be UBTI for us, once you've got the REIT on your books, it's a pretty clear runway to selling and getting cash. So interesting vehicle seems to be continuing. I'm having discussions now with a donors team about another REIT gift. I don't know what could be triggering the sudden upswing in donations of this sort. If anyone knows, I'm happy to find out. But yeah, that was an interesting one to me just because it was something that we did so little of until the very end of the year, and then it was a whole bunch of it.
Yeah, and carrying through from last year, with trends and part of what we talked about in our November webinar, definitely precious metals, and we're still seeing some inquiries going into 2026 on that. Again, and we've talked about this before, and we have another webinar about our shiny drivey things. Oftentimes with the precious metals, this is not a fair market value deduction because of the tax treatment of precious metals and how they're treated within, the appraisals and the valuation. Tends to be a more basis charitable deduction, but you have a number of donors that's not really the main driver of what they're going for. They're going for how they can use this liquidity for charitable good. So, and oftentimes it seemed like a common thread that we had was these were maybe the inheritors of the precious metals. So it may not have been, my collection that I've been working on for 30 years, but it may have been, my dad's collection that he had that was being left to me. And, I didn't have that same interest in the metals, but I wanted to have something good come of it. Some of it could be that there were folks that were picking it up on the side just to have for the fun of it, because it would be fun to have this gold lying around or this silver lying around. And, ultimately, all of a sudden, this gold and silver just shot through the roof. And, to some degree in their minds, although it had increased in value, mentally in their head, it was still that initial investment value. So the idea of making that gift and, converting that to charitable liquidity and doing some kind of charitable good with that just made sense more so than the idea of what their charitable deduction would be out of it. But because it is kind of that different nuance to it, going back to Brian's analogy of for every 8 inquiries, there might only be one, we did see a lot of that. We saw a lot of inquiries, and we had a lot of activity, but definitely not to the degree that we would to match the inquiries, which is, kind of our status quo with these. So, the VRBO and Airbnb real estate space definitely was something that we had, a handful or so tied in, which I think for us was a lot. We have one donor in particular that, they've done 2. They did one towards the end of 2025, one in 2026. They're looking at doing another one in 2027. And these are a little bit different because of that churn of the renters, the short-term rentals involved in it. It does have a little bit of a different nuance than the standard real estate. We had one in one part of the country where there was, a very challenging dynamic between the homeowners association and the rental company that was actually managing the rental process. So, that took special things to navigate. You have the dynamics of what happens when something goes wrong with the property, or, different things that can be unpredictable because of that churn of renters that come through on a consistent basis. So it definitely does have its own unique nuance that's a little bit different than our normal situations with those. And then, back to what we were saying before, the idea of the group business interest donations. And these can be anywhere from, 4 partners to, we had a couple hundred in one scenario. We had one that was probably, 12 or 15 different people that were all collectively making their donation of business interests. And I think, it's important to recognize, as a nonprofit in particular, when you have that bird of a feather type of scenario, the best way to strategize this is really the idea of where is that single one-stop shop that those assets can go, because the receiving end, the buyer of these, doesn't want to be dealing with 9 different nonprofits, for 9 different donors and 9 different charitable affiliations. So, you're going to scare away the buyers of these interests if you start getting too many proverbial cooks in the kitchen. And so I think, that along with the overall DAF giving that we talked about at the top of the slide is really important to recognize those opportunities where the nonprofits can be benefiting from these at the end of the day, but that intermediary might be necessary for that greater good because that's what's going to be easiest for the donor to get the job done while the charity or the nonprofit can benefit on the back end after everything is processed, after everything is liquidated, and getting those benefits from the grants that come out of those donor advised funds rather than doing the gift directly. So as we focus, Ryan, I'll let you talk about the tax law and the impact.
And if I could maybe just jump in half a second. So just
Yeah.
everybody remember that the Q&A down at the bottom, we had hoped this would be fairly interactive, and I would give that goal an F so far. So there, nothing has come in. So if there are any questions sort of on any of the cases that Ryan and Laura have covered, that'd be great. So we can definitely expound on any of those that would be of interest to the group. And Ryan knows too, we're talking about sort of these group cases. So we actually had one that came in, I think it was December 30th, and it was a PE group, and I think it was 23 private equity fund interests. And this was interesting, not only because of the asset and the timing, which was a maneuver in a huge way. And I think Lynn already is on the call here today, so she's the one that I sort of quickly gave the reins to help Sherpa that one through. But the other interesting thing about that is it's not once a year, but it's probably once every other year we will have somebody join whatever the current presidential administration is, and then have this sort of divestment window. And we've had a series of these. They tend to be very large donations, but a series of these types of donors that kind of come and say, look, we've got these interests sort of strewn all over the place, or more unique type interests, but we have to be able to divest of these, within in this case, I think it was like a 10-day period or something pretty tight. So yet another perhaps unique way that people are otherwise motivated to make these gifts that you otherwise maybe not. I never thought about that until we started doing these maybe 10, 15 years ago for various people joining the subsequent administration. So just to make that point. But again, the Q&A at the bottom, stick anything in there because we want to be able to respond to, and we'll take all the Q&A from this session, obviously add it to the one on Thursday, and then we'll be able to include that as part of the video posted on YouTube as well.
Yeah, thanks, Brian. And I'm sure as we as we talk about the tax law now, that'll prompt some questions, which I probably won't have the answer to immediately. But I guess as we looked at the tax law in 2025, looking forward to 2026, it's always a little bit interesting because you can anticipate that the law is coming, but you don't know what's going to be in it, and you don't know how people are going to react. But you can expect that there will be some arbitrage of people saying, should I donate now or wait until the new year? And in this case, I think that was mostly driven by financial advisors. They saw some limitations that, to be clear, do impact charitable giving. But at least speaking only for myself, I think that impact is maybe a little bit muted in the non-cash giving space. Specifically, what I'm thinking of are the floor and the cap. There is a 0.5% floor now in 2026. So for a donor whose AGI, adjusted gross income, is $200,000, if they want to take an itemized charitable deduction, it has to be 0.5% or more. For a $200,000 AGI, that means $1,000 gift. Nearly all of the donors that we deal with are going to easily be able to clear that threshold, and I imagine that is true for everyone watching this as well. So I don't really think that 0.5% floor is all that meaningful. The cap, the limitation on the high end, is maybe a little more material just because the percentage is greater. Donors who are in that highest tax bracket, the 37% ordinary income bracket, can only take a deduction that benefits up to a 35% net write-off. So that is a little bit more detrimental. But again, I don't see that being hugely consequential for us because so many of the donors that we run into are making gifts because they have significant capital gains, not ordinary income in the year of gift. And the capital gains doesn't have that same limitation. It's still that 20%. So really that top end limitation, it is a bit of a haircut from 37 to 35%, but I don't think it's going to make a big impact. And as I was preparing this slide, I was thinking though, well, actually maybe it's the increased SALT cap, the state and local tax deduction that will really make the biggest impact. And it would be, I think, indirect, but I think for charities, the benefit, and I don't think this is limited to the donor advised fund space. I think this is probably true for all charities in the country. Um, because that SALT cap limitation went from a 10K limitation, which is quite low for state and local tax that you can write off, up to $40,000. The expectation is that that's going to meaningfully increase the number of itemizers from 2026 onward. I think I saw that the estimates were it's currently about 10% of filers itemize, and that's expected to go to up to 14%. That's a 40% increase in the number of itemizers. And for the gifts that we're talking about, those are all taken as itemized deductions. So for charities broadly, more itemizers, I think, can only be a good thing. So I think that increased SALT cap has probably not gotten enough attention in the nonprofit space as something that may actually lead to more charitable giving. That's a prediction by me that may be totally off base, but that's just kind of a guess.
And it's interesting because when I spoke with some folks and we were talking about how our 2025 finished, they were like, "Oh, well, you think 2025 was busy. Wait until 2026 as all this is living and breathing." And, some of the tea leaves are really anticipating that this will be, I have a counterpart that speaks nationally that talks about, charitable giving on sale in 2025. Well, I think his estimate would be that 2026 is the biggest blue light special for charitable giving. So we'll see how it shapes up. We'll see if everyone is proven right with that.
Yeah, and I will say 2026 to start, at least in the first few weeks of the year, was slower than 2025, relatively speaking. It felt like we didn't really have any time to catch our breaths at all a year ago at the beginning of
Mhm.
2025. 2026, thankfully, we did. And then in the last, I would say, 3 or 4 weeks, we've started to see gift activity ramping up. I think as people turn to their tax preparation for 2025, they start thinking about what they need for 2026. That is a pretty common trend every year. And then those gifts kind of get materialized after the donor's accountants file and take their week off in the middle of April and then return to the office in late April and May. And then that's kind of your mini busy season in the first half of the year. So we're seeing that again. I will say I was very appreciative that it was a little bit slower because that ESOP gift that I mentioned, uh, the donation happened at the end of 2025, but the sale happened in early 2026. And ESOP sales are very, very complicated because they typically involve subordinated notes that all of the sellers, including the DAF, have to take back. And so there is a lot of negotiation and discussion that we got pulled into. So Russ Willis, who's probably on the webinar here, and myself put in a lot of time in the first few weeks of the year working on that ESOP sale. Um, what have we seen in terms of 2026 completed gifts? Brian mentioned this actually already. The private equity LP interests from a single donor that came in at the end of last year, but a lot of those gifts were not fully completed until early 2026, which the donor was fine with. It wasn't something where as Brian said, it needed to be a 12/31 deadline. Um, it, that's an interesting thing because again, as Brian said, we've seen that sort of inquiry before, and it's actually the second year in a row we've had a donor come in with a lot of private equity donations So one donor, is kind of the inverse of the company donation, where you have one company, multiple donors. This is single donor, multiple investments to be donated. Um, that's complicated to manage because we're talking about due diligence on a number of different assets, which may all look similar but aren't the same, and they may not have the same requirements. They may not have the same fund administrators or paperwork. And I was thankful that someone else, Lynn, was working on that one. Because if I had to do one for the second year in a row, I think my head would have exploded, which is probably why Brian didn't send that one over to me. Um, and then something that we also saw, and I worked on this a little bit, Laura and Brian worked on it more than I did. There was a significant, very large private company investment. This was deep into eight figures, I believe was kind of the initial commitment. Expected to go, I think, a little bit higher than that. Very, very sizable investment being made. We do more and more of these alternative investments via a DAF vehicle. And we'll talk more about that too yet in this webinar. And so that was a prominent example for us early in the year to see a gift of that size. But donors are interested in this at smaller levels as well. We have some donors who've done it, $1 million, $2 million investments. But even last week, I had multiple inquiries of donors who wanted to do this kind of in that $500,000 to $1 million range. That can still be very appealing, and usually it's something where the donor has an opportunity to invest in what they think is a really attractive startup or some kind of private equity vehicle. But it can be a hedge fund, it can be venture capital, it can be real estate development. Private equity and startups tend to be the most common, though.
Yeah, and it's interesting how that unfolds because I feel like a lot of times those donors have an affinity for a certain space. They've been in the space, they know the market, they trust the places that they want to invest, they have a history there, and they want to be able to, take that risk benefit reward that they've experienced personally and add that into their DAF exposure, which I think is a really neat trend that we see unfold. Going into more of our 2026 activity, we talked about it being quiet, but then, as things began to shift, it began to shift to big. And, it's interesting. We had a staff call not too long ago where we were just talking about how everything seemed to be mega. We had, a lot of the inquiries we were getting were extremely large tracts of land. We had very significant, business interest donations. A lot of things that are on the horizon, and maybe that goes back to the idea of the, blue light special on charitable giving, but a lot of this is the idea of a lot of these inquiries are just shaping up to be what seem to be really large transactions for us to see. And while we see them and we experience them, the idea that we're seeing this frequency is a little bit more, I think, than what we've seen before. But then we also have the idea of, the real estate investors, the mom and pops, the folks that are doing the retail. That's a long-term trend that is still evolving and still continuing on, where we have, these folks that sometimes they are the initial investors. Again, sometimes I think we've had kind of the inheritors of this, where, dad might have had a portfolio of 12 properties that he managed and had as tenants, and now the family hasn't inherited these and they want to dissolve out of them. Or the joke that I've often made sometimes with some of these folks is the idea of the 1031 exchanges. And, it tends to be a train that you have trouble getting off of without breaking your neck. So the idea of how can they, exit out of that last 1031 exchange and not have all of that accelerated gain that they've accumulated over the years that they're paying that big tax bill on. So I think a lot of these are still kind of that mom and pop, but they're investors, and it's a big piece of what they have in their wealth and their capital. So, it's still going, and I don't know if there's a lot that'll really change that, in the near term. Ryan, what do you think?
No, I don't, I think it's only going to continue. I mean, and I think, you know, one thing that's going to make it continue is the short-term rentals, right? That you talked about. Like
Yeah.
previously, we were thinking about these sorts of investors as being, you know, either in commercial real estate or doing your more traditional kind of long-term residential tenant. You know, short-term rentals is a whole other category. So I think it's only going to expand.
Yeah. And then with crypto, I think we're seeing a little bit of a quieting at the moment. It's not really halting, but I think definitely, maybe that's because it was so busy at the end of the year, where we were seeing two or three of these, you know, Ryan had mentioned Alex, who was doing a lot of these transactions for us at the end of the year, where we were getting almost, three or four pings a day from Alex about, this gift being completed, that gift being completed. I miss Alex. I feel like it's been a week or so since I've heard from her about these transactions. So it's definitely, been quieter in what we're seeing. But I think also, you know, crypto's one of those things that, and we've seen it before, where a lot of these are long holds. So even though the market might not be the same as what the market might have been, you still have a lot of donors that when they're looking at this, it is a highly appreciated asset there in their portfolio because they've held the crypto for 3, 4, 5, 10 years. And at the time that they entered into the space, it wasn't worth a lot. So, or it wasn't worth anywhere near what it's compared to now. So I think, that'll probably continue to ebb and flow through the year. Expectations and opportunities for 2026, Ryan.
Yeah, this actually ties in a little bit, at least the first bullet point, to a question that came in during the last slide of who's bringing these opportunities to us, and I think Brian typed out an answer to that. Um, One thing that we've seen more and more of is uh, bespoke uh, gifts and sometimes investments, like I mentioned, uh, done via a donor or a family of donors family office. That's become more and more common. Family offices obviously are for the extremely wealthy, and those types of gifts where it's run through a family office usually are introduced to us either via another charity, typically another donor advised fund, or perhaps some kind of external advisor, sometimes a financial advisor, but oftentimes it is a law firm of some sort that has some kind of tax, trust and estate, family office focused practice. We've seen more and more of that, and then it kind of gets handed off to the family office, and they sort of have that internal team. It's the whole point of a family office where they've got internal, legal, investment specialists, tax specialists, and they can kind of run point for the donor and work with us on what is typically a very complex donation. These donors are interested in alternative investments. That's kind of the reason that they have a family office to begin with. And so that, much like the ESOP giving, presents, I think, an opportunity for sort of mission alignment where they're looking for charitable opportunities in an alternative investment. And that's kind of what we do already anyways. So seeing a lot more of that. Um, the charitable remainder trusts, Laura, you've been working on that a lot lately.
Yeah, and I think that's a great opportunity. And once again, real estate is a good indicator on that. We have one transaction going on right now with, a higher value real estate property. Paul Casperson on our team will talk in the past about, some of the referrals we get from the colleges and universities that may do their own CRT programs but don't take the non-cash assets. We can definitely take it on the front end of that non-cash asset and then, once that liquidity happens, flip that over to the other charity, flip that over to the college and university to be part of their normal pool of charitable remainder trusts that they do. So there is a lot of flexibility there. But I think what a lot of folks are liking about that activity is the idea of how that can just increase their charitable capacity. So I think that's a great avenue to be able to pursue, with the non-cash assets in particular because of the high value. And then also the idea, and we talked about this a little bit in November, but the idea of the designated funds. I think it's important for nonprofits and donors to understand that even if they do have, a strong affinity for one or two specific organizations, it doesn't necessarily have to be a donor advised fund that ends up being the recipient of these dollars, or it doesn't have to be directly, the idea of going directly to a specific charity. There might be reasons why, it has to come to us first, but ultimately go to the charity. And having that designated fund be a component of that intermediary in that process is extremely helpful. We had, the one we talked about in November, the charities had to receive those assets, but they didn't want to keep those assets. So the fact that they were able to put it into a a designated fund here with us allowed them to have the best of both worlds with those benefits. So there's a lot of flexibility that can be arranged, as we think through these strategies with donors and nonprofits and with their advisors. So as we go into, more of 2026, I think definitely we're seeing more within the AI related business interests. Ryan, as you've indicated, the phone's still ringing for us with those.
A lot.
And there's a lot of indication that that's going to continue to be part of it. A lot of what I was reading from, the M&A markets is that the outlooks look good. And while there seem to be a lot of, the mega deals that we were talking about, that seems to be a market trend in a larger scale, with a lot of those potentially being AI related. And the idea that, the M&I market is really looking at, strong long-term strategic acquisitions. We're definitely seeing that within, the tech and financial services and healthcare and energy spaces and utilities. A lot of great activity that may still be happening on the horizon. I think Ryan and I have each had a handful of calls already in regards to companies that are looking at an IPO strategy, and looking at, filing the filings that need to take place to be able to initiate that IPO process. So I think that's another area where we'll see more of those group donations that we were talking about with those folks that may be in advance of that IPO strategy. Um, and then also, I think similarly, we talked last year, I think, about, the concern about what was going to be with the tax changes and with the tariffs and the different things that were going on in a global perspective. And I think it's kind of, same thing, different flavor, with there's still a lot of global uncertainty out there. There's still a lot of, right now it's geopolitical that is going to be, maybe impacting more of that focus inward in regards to the M&A activity and the growth activity that's happening, in our own backyards, rather than trying to do things on an international scale. Ryan, any other thoughts?
Yeah, I think as we were discussing kind of specifically the war here, we were talking about doing this presentation a year ago and having the uncertainty of the tax law reform, but we knew it was going to happen by year end.
Hmm.
With a war, that could end tomorrow. That could last the rest of the year. I think everyone hopes it doesn't, but that is something that is really churning the markets right now, as anyone who looks at the financial news sees. It's been, the top story for 2 weeks now. And that, as Laura, you said, that could have some knock-on effects in terms of sort of domestic activity. I did a donation at the end of last year that it was in domestic oil and gas production. Uh, I have to imagine they are probably feeling pretty good about where they're at right now because of what's happening in the energy markets. So that can make things very difficult to predict. We do expect to see more IPO activity. I think there's the expectation that there's going to be some of the largest ever public offerings this year, but that can be very uncertain. Those can be can and are often put on pause with little notice, and that can really change those donors' plans. I will say, as a charity, even if you are taking stock that's pre-IPO stock, um, You don't know when that public offering is going to be concluded. And even if it does go forward, you're probably still going to be subject to a lockup for at least 6 months. So if you take the stock and it goes public, then you're stuck holding stock that you can't sell, and you've got uncertain market conditions. So that stock that might be worth $100 when it goes public could go down, hopefully goes up, but you don't know and you can't sell anyways. So the IPO activity, there's a real opportunity there, I think, but it's more complicated than just a gift of public, freely tradable Amazon or Apple stock that you get today. So that's what I'd say about the IPO stuff.
And just, thinking as we wrap up and get ready to answer any questions that we may have, and this is maybe a little bit of a repeat of Brian's webinar last month in regards to what can the nonprofits do. And while we're definitely here to help make these gifts happen, this really is, the heartbeat of how this functions is really with the nonprofits that are on the boots on the ground and have these relationships with the donors and have the know what's going on with their donors. And, for any nonprofit, if you're not tracking, the backgrounds of your donors, if you're not keeping track of what donors may be landlords, what donors may own businesses, what donors are engaged in businesses, some of the best transactions I've seen haven't been necessarily the business owner, but it could be the spouse of the business owner that has their own shares, or it has the kids of the business owner that have their own shares, or have been the long-term CFO that's getting ready to retire. Any of those people that are tied in with these privately held businesses, those are the folks you want to keep on your radar, and those are the folks you want to be talking to and having your ear on the street as to when they may be going through some of these changes that could precipitate being able to take these opportunities to create that charitable capital to benefit your organizations and to benefit your local regions. Talking about it within your websites, talking about it in your roles with the other advisors, that idea of really being able to really talk about, bunching is going to be a big thing when we talked about with the SALT and the other tax mitigation strategies. These are going to be the best assets for bunching and looking at the idea of how can you use these assets to pre-fund 3, 4, 5 years of giving, whatever that case may be. Those are the best avenues that can really help the organizations benefit from these strategies and benefit from these activities, is really making sure you're on the front lines to hear and see and know when these opportunities may be arising with your donors so that you can be that helper to help them get these, to us so that we can get them across the finish line. So, and I think we're open for questions, Brian.
I think we may be about a minute over, which is totally fine. So I've been answering a bunch of questions as we go through. So I appreciate, after my cajoling you guys, to ask more questions. One thing I did want to point out very, very quickly, and maybe if you can even go to the next slide, I think it's got the list
Yeah.
of webinars, because I know David had asked about, actually, we don't go that far back with the DST. So a DST question came up, and Ryan had done that webinar in the past. But very quickly, we're talking about the mega gifts. I don't think these are going to happen. A lot of these aren't going to happen. But when we talk about sort of the sizing of these, I think there was one week, and I'm probably off a little bit, but I think we had maybe 4 or 5 opportunities. I think there were maybe like 200 million plus for individual transactions. We're working on one right now that's probably not going to work out, but like a billion plus as a CRT potential donation. The only point is that is very unusual for February, March conversations of that number in one week of those sizes. I think last year we did maybe 3 gifts, and or bunched gifts of sort of that 200 million plus, 150 million plus or so. So to have, again, 4 or 5 of these come up now, they're not going to happen, and they're not all going to happen. But my point is, it's unusual how large, and in particular after the tax law change, when I think many people would think those might be the ones that otherwise wouldn't do it. You have some phase out issues, but it doesn't seem to be slowing down the very, very large conversations is the point. So, but with that, I thank you so much, Ryan. Thank you so much, Laura. This was great. We'll be sending this out next week, and any questions anybody has would be helpful, let us know. Thanks, guys.
Thanks all.
Thanks.